Hi, what is book value in stocks? The book value of a stock is the company's net worth calculated by subtracting its total liabilities from its total assets. This represents the theoretical amount shareholders would receive if the company liquidated all its assets and paid off all its debts. It's a measure of a company's intrinsic worth based on its financial statements, and it is also calculated per share, that is book value per share or BVPS. Now the calculation: book value, it is equal to total assets minus total liabilities. Now book value per share, BVPS, it is equal to total assets minus total liabilities divided by total outstanding shares. To calculate BVPS, you can also use the formula total shareholders equity by number of common shares outstanding. If the company has preferred stock, you must subtract the value of a preferred stock from the total shareholders' equity before dividing by common shares outstanding. Now, how it's used? The book value. Valuation. Investors compare a stock's market value to its book value per share to determine if it is undervalued or overvalued. Stability. It provides a stable benchmark, especially during volatile market conditions. Company health. It serves as a key indicator of a company's financial health, reflecting its net asset value. What it doesn't show? Book value does not account for intangible assets like brand value, intellectual property, or future growth potential. So, it should be used with other metrics for a comprehensive analysis. Is a high or low book value better? The answer is a high book value is generally preferred as it indicates financial stability and a larger asset base relative to liabilities. However, a stock's book value should be compared to its market price. A book value higher than the market price can signal an undervalued stock, while a market price higher than the book value can suggest the stock is overvalued or that the market has a more favorable view of the company's growth potential. The ideal scenario is a high book value that is greater than the market price, potentially indicating an undervalued opportunity. What is bad book value per share? A negative book value per share will result in a negative price to book value ratio. It implies higher liability than assets in the company, which can signal investors about its imminently dire condition. These companies may be having financial distress or face the risk of bankruptcy. Thank you.